If you've been investing in real estate or have been studying about real estate investment strategies, chances are you have heard of sayings like real estate market has cycles, and a cycle is typically every 7 years or every 11 years. So based on that, the real estate market is predictable. All we have to do is to time the market so we can all get rich, right? It's the one and only Double G. Sounds too easy, isn't it? Then why haven't we already gotten rich in the last 7 or 11 years multiple times? Hello everyone, this is Bojie He, your local Bay Area real estate expert, and once again, welcome back to my channel. If you have been thinking about buying or selling homes or even investing in real estate, the common question is now the right time? Different people have different timelines, but things that I've been seeing a lot of people trying to do is to time the market. So in this video, I want to explain to you what is a market cycle, how does it actually work, and why it is more difficult than you think trying to time the market. First, what is exactly a real estate market cycle? A real estate market cycle typically consists of 5 phases: expansion, peak, contraction, trough, and recovery. And how long does it take for the cycle to complete? Some economists observe to be 7 years, and others have noted 11 years. Some even would say an 18-year cycle. These are all based on observations of the economy in the last 100 years, and that's where the 7 years or 11-year cycle comes from. Here's what you need to know about these theories. Number one, yes, market cycle does exist. However, it doesn't mean when the price drops, it will drop back down to the level of the beginning. Take a look at the following chart. It's San Francisco Bay Area's housing price in the last 30 years. So in this graph, the San Francisco Bay Area's home price has gone through at least 2 cycles. Starting in 1996, the market starts surging, and then it peaked out in 2001. Soon after, it pulled back due to what we call the dot-com bubble pop. So in 2002, the market bottomed out. A temporary trough took place around that period. But then soon after, the market started recovering again. So from 2002 to 2006, the market was surging, and then it peaked out between 2006 to 2007. And then soon after that, we had another bubble that took us back into Great Recession, the credit crunch, subprime mortgage crisis, and the market started crashing in 2008. And then from 2009 to 2011, the market hit rock bottom again, and that's another trough. And then after that, the market started picking back up in 2012. And between 2012 to 2019, the market kept going up, and then it reaches new high. And this period is considered another recovery in this graph. So one thing you notice that during the previous 2 bottom period, the first one is between in 2002, the dot-com bubble. The second one is 2008 to 2011's Great Recession bottom. Both bottom period, the home prices are still higher than the previous cycle's beginning price. This indicates that the market had appreciated way more than what it crashed for. So if you're looking for the price to drop down to a certain level in order to deem it at the bottom, it's not reliable. In reality, the price may go down just a little bit and then flatten out. And then the next cycle already starts while you're still waiting, thinking that the bottom should be back to the beginning. That's the number one cause of mistiming the market. Number two, the so-called 7-year cycle or 11-year cycle is not a hard rule. You see, economy is not like physics. It is completely created by massive human actions, where physics or chemistry are based on theories that exist in nature where we can actually use all the formulas to predict or engineer a future product that will do exactly what we tell them to do. but the economy is not. It's actually a backward behavior. So, in fact, for that reason, whatever period, the 11 years or 7 year cycle can never be a hard rule. Because let's say if everybody thinks or believes that the market is going to change in the next, let's say, 2 years, because the 7 year cycle is up or the 11 year cycle is up, then everybody is going to be selling perhaps right now. Then nobody's going to buy at the same time because everybody follows that rule. Then what's going to happen is that the market is not going to shift 2 years out, but rather it's shifting right now. It's not going to hit bottom 2 years later, but rather the bottom is going to be happening right now. So you see, if you're chasing something like something that's completely caused by human behavior, then you can never hit it. It's basically a paradox. Number three, the trough or the bottom in the real estate market cycle is typically only recognized after fact. And here's why. During the trough, economic conditions are generally poor and there's often a lack of clear indicators that the market has bottomed out. And with negative market sentiments and widespread pessimism about future, it could feel that the market will continue to decline. Perfect example is during 2007 to 2009's Great Recession. I've lived through that period myself, and I can tell you how it feels like at that time, and it's not good. Another reason that the real estate market data such as home prices, sale volumes, and economic indicators are typically reported with a delay. By the time that the data confirms that a trough has occurred, the market may have already started to recover. Again, take 2008 and 2009 for example. If you look at the sold price, Bay Area's housing market hit rock bottom around early spring 2009. However, the homes that closed during that time were mostly foreclosures, which took almost 1 year to close. Therefore, the 2009 early spring data reflected the buyer's behavior and decision in 2008 spring. So, by chasing trailing indicators such as sold price, you will never be able to actually time the market that's happening right now. Lastly, identifying the start of the recovery is just as difficult as timing the bottom due to the same reason of trailing indicators. People often don't know the market has already started recovering until after fact. So with that said, if you look at the home price index of California since 2000, you see that the 2008 to 2009 period is the contraction phase and the 2012 is the trough phase. Then we know that the recovery phase had already started around 2012, and the question is, are we at peak phase now, or are we starting to contract? Nobody knows based on the current economy, and if you're trying to time the market by counting the years now, like is this 7 years or is this 11 years already since the last cycle, you won't even know from which year to start counting if you look at the graph, because you could only identify the previous phase afterwards when the next phase is well underway. In addition, the 7 years or the 11 years cycle itself isn't a guaranteed cycle either, like we've talked about earlier. Therefore, this uncertainty is a key reason why attempting to time the market is risky and why many economic experts advocate for long-term investment approach. The state of the current economy has a lot of uncertainties. We have the election, the crisis in the Middle East, the job market, and the rise of AI technology with potential bubbles. With the potential rate cuts on the table soon, it signifies the government's not so positive position on the current economy. So, if you are an investor looking for opportunities, I recommend being conservative for now. Remember, during any crisis, cash is always king. On the other hand, it is proven that in the long run, real estate assets have been stable and is a great way to hedge against inflation. So if you're looking to invest in real estate now, my suggestion is to play the long game. Use the 7 year or the 11 year cycle as a reference, but not a hard rule, and don't try to time the market. All right, that's it for this video. If you have any question about real estate in general here in the Bay Area, feel free to reach out to me and I would love to connect and help. Take care and thank you for your time. See you on the next one.